Disclaimer.
Picture this moment. You wake up this morning, check your phone over coffee, and see a number that shouldn't exist yet. Gold just shattered through $5,300 per troy ounce. Not gradually climbing over months or years, but exploding upward in a matter of hours like a pressure valve, finally giving way after decades of strain. Most people will see this headline and think it's just another market milestone, another record to add to the history books. But here's what should grab your attention right now. This isn't a celebration of gold's strength. This is a distress signal about our dollar's weakness, and the implications for every American holding savings in U.S. currency just became impossible to ignore. Let me put this in perspective for you. 3 months ago, gold was trading around $4,200 per ounce. Financial analysts were calling that expensive, warning investors to wait for a pullback before buying. Those analysts were looking at the wrong indicator entirely. They were watching gold's price when they should have been watching what central banks were doing behind closed doors with unprecedented urgency and coordination. What triggered this morning's breakout wasn't good news about gold. It was terrible news about the dollar that finally leaked into public view. According to sources within the Federal Reserve System, a confidential memo circulated to major financial institutions 3 days ago, outlining emergency measures for what they were calling the January liquidity injection. This isn't your standard monetary policy adjustment that gets announced with careful language and forward guidance. This is a panic move disguised as preventive action. The debt market was on the verge of seizing up completely. U.S. Treasury bonds, the bedrock of global finance, were experiencing what traders call a liquidity crisis. Not enough buyers were showing up at auctions, and the few buyers who remained were demanding significantly higher interest rates to compensate for currency debasement risk. When the world's reserve currency starts losing credibility in its own bond market, central banks have exactly one playbook left. They print more currency to buy their own debt, hoping nobody notices the circular logic that's destroying purchasing power with every transaction. Our Federal Reserve injected $2.1 trillion into the financial system over the last 30 days. Think about that number for a moment. That's not an annual figure or a multi-year program. That's 1 month of emergency currency creation that nobody voted for, nobody debated, and most Americans still don't know happened. The Bank of England added another $340 billion. The European Central Bank contributed $580 billion. The Bank of Japan went all in with $890 billion. This is coordinated global currency debasement happening in real time. And gold has surged to $5,300 is the market's blunt verdict on what this money printing means for everyone's savings. But here's where it gets really interesting. The price spike you're seeing isn't primarily driven by new buyers rushing into gold. It's driven by desperate sellers trying to exit short positions they never should have taken in the first place. Let me explain what's happening in the London over-the-counter markets right now, because this is the story behind the story that major financial media won't tell you. For decades, large bullion banks have been selling paper contracts for gold they didn't actually possess. These contracts promised delivery of physical gold at specific prices, but the banks were counting on most contract holders never demanding actual metal. They would just settle in cash, take their profits or losses, and move on. This system worked beautifully as long as confidence in fiat currencies remained high and physical gold demand stayed predictable. Those conditions just evaporated. According to data from the London Bullion Market Association, physical delivery requests have increased by 340% in the last 60 days. Contract holders aren't accepting cash settlements anymore. They want the actual metal, and they want it in their possession immediately. This has triggered what market professionals call a short squeeze, but the clinical term doesn't capture the magnitude of the problem. These bullion banks made promises they cannot keep, and now they're being forced to buy physical gold at any price available to fulfill contractual obligations. Every purchase they make to cover their short positions drives the price higher. Every price increase triggers more margin calls on remaining short positions. Every margin call forces more desperate buying. This is a self-reinforcing cycle that doesn't stop until either the shorts are completely covered or the entire paper gold system collapses under the weight of its own fictional accounting. At $300 per ounce this morning, we're watching that collapse accelerate in real time. You might be wondering why this is happening now. What changed to trigger this crisis of confidence in paper currency and paper gold contracts? The answer appeared on trading screens at 6:47 a.m. Eastern Time, when the U.S. dollar index dropped by 20% in less than 3 hours of trading. For context, the dollar index typically moves by fractions of a percent per day. A 5% move would be considered catastrophic. A 20% decline in a single morning represents something that hasn't happened in modern financial history. The dollar index measures the value of the U.S. dollar against a basket of major foreign currencies. When it drops by 20%, that means every dollar in your bank account, every dollar in your retirement fund, every dollar you've saved for your children. As education just lost 1/5 of its purchasing power compared to euros, yen, and pounds. But here's the part that should worry you even more. Those foreign currencies are also being debased by their own central banks in that coordinated liquidity injection we discussed. So if the dollar is falling 20% against currencies that are themselves losing value, what does that tell you about global confidence in the entire fiat system? International investors are answering that question with their wallets. They're fleeing dollar-denominated assets at a pace that's overwhelming currency exchange systems. According to Bloomberg terminal data, foreign holders of U.S. Treasury bonds have sold $840 billion worth of holdings in the last 3 weeks. That's the fastest liquidation of dollar assets since records began in 1978. These aren't retail investors making emotional decisions. These are sovereign wealth funds, central banks, and major institutional investors with access to information and analysis that most Americans never see. They're selling our bonds and buying gold because they've concluded that the mathematical reality of our debt situation has finally overwhelmed the political will to address it responsibly. When you combine a $35 trillion national debt with trillion-dollar annual deficits, trillion-dollar emergency liquidity injections, and a Federal Reserve that's trapped between stopping inflation or stopping a depression, the endgame becomes clear. Our currency is being systematically devalued, and gold represents the only major asset that cannot be printed, debased, or inflated away by government decree. Think about what this means for your personal finances right now. If you have $100,000 in a savings account earning 4% interest, you're excited about that $4,000 annual return. But if the dollar loses 20% of its value in a matter of months, your $100,000 is now worth $80,000 in real purchasing power. Your 4% interest gain is completely erased by currency debasement losses that your bank statement will never show you. This is the hidden tax that's being imposed on every American who trusted the system and played by the rules. Gold, hitting $5,300, isn't about gold becoming more valuable. Gold is doing what it's always done. It's sitting there being scarce, durable, and impossible to counterfeit. What's changing is the value of the paper currencies we're measuring it against. When central banks around the world simultaneously create trillions in new currency to prevent a debt market collapse. They're essentially admitting that the existing currency supply has been stretched beyond sustainability. The $5,300 price tag on gold is the market's way of repricing that reality in real time. This is just the beginning of a much larger repricing event that most Americans aren't prepared for. The mechanisms that got us to $5,300 this morning haven't stopped. They're accelerating. Now, let's talk about the evidence that separates speculation from reality. Because anyone can claim that gold is rising due to currency concerns or institutional buying, but the data that leaked from the International Monetary Fund 3 days ago tells a story so dramatic that it fundamentally changes how we need to think about global finance moving forward. According to documents obtained by Reuters from confidential IMF briefings, central banks around the world purchased 1,847 metric tons of gold in the last 30 days alone. To put that number in perspective for you, the entire previous decade saw central bank gold purchases totaling 1,923 metric tons. Read that again slowly. In 1 month, global central banks bought almost as much gold as they did in 10 years combined. This isn't a trend or a shift in asset allocation strategy. This is a wholesale abandonment of confidence in the fiat currency system by the very institutions that created and managed that system for generations. The World Gold Council, which tracks official sector purchases, initially questioned these figures because they seemed too extreme to be accurate. But confirmation started coming in from national sources. The People's Bank of China, which had been quietly accumulating gold for years, suddenly declared an additional 412 tons in official reserves that weren't previously disclosed. The Reserve Bank of India added 287 tons. Poland's central bank acquired 156 tons. Even smaller nations like Vietnam and Thailand added triple-digit tonnage to their vaults in what can only be described as a coordinated flight to hard assets. What you're witnessing is called de-dollarization, but that academic term doesn't capture the urgency of what's actually happening. These central banks aren't gradually diversifying away from dollar reserves over years or decades. They're executing emergency exits from dollar-denominated assets and converting those holdings into physical gold as fast as the market can deliver it. When the institutions responsible for maintaining global financial stability are behaving like passengers abandoning a sinking ship, you need to ask yourself what they know that hasn't been announced to the public yet. The BRICS nations have taken this strategy even further with an announcement that stunned global markets last week. Brazil, Russia, India, China, and South Africa, along with newer members Saudi Arabia, Iran, UAE, Ethiopia, and Egypt, jointly declared the creation of a gold-backed trade settlement system that bypasses the dollar entirely. This isn't a proposal or a framework for future discussion. According to the official BRICS communique, The system is already operational and has processed $340 billion in trade settlements using gold-backed digital certificates over the last 45 days. Think about what this means for our country's economic leverage. For 70 years, global trade has been conducted primarily in US dollars, which meant that every nation needed dollar reserves to buy oil, pay for imports, and settle international transactions. This arrangement gave America extraordinary power to finance our deficits by simply printing currency that other nations were forced to accept and hold. That system just cracked wide open. When major oil producers like Saudi Arabia and UAE can now accept gold-backed payment for their energy exports instead of dollars, the fundamental demand for our currency in global commerce begins to evaporate. The Chinese yuan gold connection provides a perfect example of how quickly this transition is happening. The Shanghai Gold Exchange, which is the world's largest physical gold market by volume, has seen trading activity increase by 670% in the last 60 days. But here's the crucial detail that most analysts are missing. The majority of that volume isn't Chinese buyers. It's international corporations and sovereign entities using Shanghai's exchange to convert their dollar holdings into gold, then using that gold as collateral for trade deals denominated in yuan. They're essentially using gold as a bridge currency to move away from the dollar without directly challenging American financial dominance in a way that would trigger immediate retaliation. This brings us to the supply side of the equation, because rising prices mean nothing if there's abundant supply available to meet demand. What's actually happening in the physical gold market right now should concern every American who thinks they can simply decide to buy gold whenever they are ready. The window for easy access to physical metal is closing faster than most people realize. Major Swiss refineries, which process roughly 70% of the world's newly mined and recycled gold, are reporting something unprecedented. According to statements from Valcambi, PAMP, and Argor Heraeus, they have a 6-month backlog for 1 kilogram gold bars. 6 months. If you place an order today with a Swiss refinery for a standard 1 kilo bar, they're telling you that delivery will occur sometime in late summer, assuming nothing disrupts their production schedules or supply chains. And these aren't small boutique operations. These are industrial-scale facilities that process hundreds of tons of gold annually. The backlog exists because refineries are receiving orders from central banks, sovereign wealth funds, and major institutional buyers that dwarf anything in their historical experience. One refinery executive, speaking anonymously to the Financial Times, described the situation as trying to fill an ocean with a garden hose. The gold is being mined and processed as fast as physically possible, but demand has increased so dramatically that supply simply cannot keep pace at any price point. This is where the $13,100 price becomes easier to understand. It's not that gold suddenly became more valuable overnight. It's that the availability of physical gold at lower prices has been completely exhausted by buyers with deep pockets and urgent timelines. When central banks are willing to pay any price to secure physical metal, and when refineries have 6-month waiting lists, the price has to rise until it reaches a level where some current holders are willing to sell. At $300, we're apparently not at that level yet because the backlog keeps growing. The premium structure in the retail market tells an even more alarming story. Normally, you can buy physical gold coins or bars at a small premium over the spot price, usually 2% to 5% depending on the product and dealer. According to data from the U.S. Mint and major bullion dealers, premiums on American gold eagles have spiked to 18% over spot, while generic gold bars are commanding 12% premiums. These aren't price gouging spreads. These are supply shortage signals that indicate physical metal is becoming genuinely scarce in forms that regular investors can actually purchase and store. Have you noticed that coin dealers are now limiting purchases to 2 or 3 coins per customer? That's not a sales tactic. That's rationing. When businesses that normally want to sell you as much as possible start restricting quantities, it means they're more worried about running out of inventory than they are about maximizing short-term profits. They're trying to stretch their limited supply across as many customers as possible because they don't know when or if they'll be able to restock at reasonable prices. Now, let's talk about what the ultra-wealthy are doing, because their behavior often provides early warning signals about economic shifts before those shifts become obvious to the general public. According to a confidential survey conducted by UBS Wealth Management and leaked to the Wall Street Journal, billionaire family offices have moved an average of 40% of their liquid portfolios into physical precious metals stored in private vaults over the last 90 days. 40%. Think about what that means. These are families with hundreds of millions or billions of dollars in assets, managed by sophisticated financial advisors with access to every investment vehicle imaginable. They're not moving 5% or 10% into gold as a diversification play. They're repositioning nearly half of their liquid wealth into physical metal. They're doing it in a way that completely bypasses the traditional banking system. Private vaulting services in Switzerland, Singapore, and the Cayman Islands are reporting waitlists for new accounts. BRICS Global Services, which operates secure vaulting facilities worldwide, announced that they are at 97% capacity and have suspended new account openings until they can expand their facilities. Loomis International reports similar constraints. The physical infrastructure for storing large quantities of gold outside the banking system is being overwhelmed by demand from clients who want their metal segregated, allocated, and immediately accessible without any intermediary involvement. This isn't paranoia. This is informed preparation by people who have the resources to understand what's coming and the means to protect themselves. When families worth billions are willing to pay 1% annual storage fees to keep their gold in private vaults instead of earning 4% interest in bank accounts, they're making a clear statement about which asset they believe will preserve wealth and which will be eroded by inflation and currency debasement. The really interesting pattern emerges when you look at who's buying and who's selling. According to Federal Reserve flow of funds data, U.S. households and institutional investors have actually been net sellers of gold over the last 6 months. Americans, broadly speaking, have been taking profits on gold they bought years ago at much lower prices. That metal is being immediately absorbed by foreign central banks, sovereign wealth funds, and international family offices who view anything under $6,000 per ounce as a bargain based on their projections for currency debasement. We're essentially watching a wealth transfer in slow motion. American retail investors are selling their inflation insurance to foreign institutions and governments who understand that the global monetary system is in the process of a fundamental reset. By the time most Americans realize what's happening and try to buy back into physical gold, the price will be substantially higher, and the availability will be substantially lower than it is right now. The mining sector data reinforces this supply constraint reality. Global gold mine production peaked in 2018 at approximately 3,300 metric tons per year and has been declining since then as easily accessible deposits have been exhausted. According to the World Gold Council's latest production survey, 2025 production is expected to come in around 3,100 metric tons. Meanwhile, just central bank demand alone hit 1,247 tons in the last 30 days. If you annualize that pace, you're looking at 22,000 tons of annual central bank demand against 3,100 tons of annual mine production. Those numbers don't work. The math is impossible. The only way the market clears is through dramatically higher prices that pull recycled gold out of existing jewelry and industrial applications, or through some buyers simply being unable to access physical metal at any price. This is the supply vacuum that is driving gold through $5 to $300 and showing no signs of slowing down. What we're seeing is a market that's discovering in real time what happens when the world's most powerful institutions simultaneously decide they need to own more of an asset that cannot be manufactured or printed into existence. The result isn't a gradual price adjustment. It's a vertical spike that reflects decades of currency creation finally being reconciled against a finite supply of monetary metal that's been the foundation of value for 5,000 years of human civilization. Let's do some math that nobody in official positions wants to discuss publicly, because once you understand the numbers behind our national debt situation and compare them to the physical gold held in Fort Knox and other government repositories, the path to much higher gold prices becomes not just probable, but mathematically inevitable. The United States currently holds approximately 8,133 metric tons of gold in official reserves, according to the Treasury Department's most recent disclosure. That's about 261 million troy ounces. At today's price of $5,300 per ounce, the gold is valued at roughly $1.38 trillion. Now let's look at the other side of the balance sheet. Our national debt just crossed $35 trillion and is growing by approximately $1 trillion every 100 days based on current deficit spending patterns. Here's the calculation that should concern every American. If you divide our total debt by our total gold holdings, you get a debt-to-gold ratio of about $134,000 per ounce. That's what gold would need to be priced at for our existing reserves to theoretically back our outstanding debt obligations. But let's be more realistic and just focus on this year's deficit, because that's the immediate problem that's forcing all this emergency currency creation we've been discussing. The Congressional Budget Office projects that our 2026 federal deficit will reach $2.3 trillion. That's not the total debt. That's just the gap between what we're spending and what we're collecting in revenue for this single year. If the U.S. government wanted to back just this year's deficit with gold at current market prices, they would need to acquire an additional 434 million troy ounces. That's more gold than exists in all the central bank vaults worldwide. The entire above-ground supply of gold ever mined in human history is only about 6.7 billion ounces, and most of that is in jewelry, industrial applications, or private hands that have no intention of selling at current prices. So what happens when an immovable supply meets an unstoppable debt spiral? The price has to adjust to a level where the existing supply can adequately serve as monetary backing for the currency in circulation. According to analysis by several independent economists who specialize in monetary history, including data published by the Mises Institute, that equilibrium price for gold falls somewhere between $8,000 to $512,000 per ounce when you account for the total monetary base rather than just government debt. At at least $500 per ounce, the U.S. gold reserves would be valued at approximately $2.2 trillion, which would cover this year's deficit and provide some cushion for next year's shortfall. This isn't a prediction about where gold will go based on market sentiment or technical analysis. This is a mathematical calculation about where gold needs to go if it is going to serve its historical function as the backing for currency and the foundation of monetary stability. You might be thinking that this sounds extreme or that surely our government has other options besides allowing gold to rise to $8,500. Let's talk about what those options actually look like in practice. Option 1 is dramatically cutting spending, which would require reducing the federal budget by about $2 trillion annually. That means eliminating roughly 30% of all government programs, benefits, and services overnight. Not politically likely. Option 2 is raising taxes by a similar amount, which would require increasing the average American's tax burden by about 40%. Also not politically viable. Option 3 is continuing to print currency to cover the gap, which is what we're doing right now with that January liquidity injection we discussed. But every $1 trillion printed dilutes the value of every existing dollar in circulation, which is why the dollar index dropped 20% this morning. Option 4 is defaulting on our debt obligations, which would crater the global financial system and destroy America's creditworthiness for generations. None of these options are attractive, which is why gold is being allowed to rise as the pressure release valve for a system that has no other politically acceptable escape route. The timeline for reaching $8,500 depends on how quickly confidence in currency-based solutions continues to deteriorate. Based on the current rate of change, some analysts are projecting we could see $6,000 gold by the end of February and $8,500 by sometime in the second quarter. That might sound aggressive, but remember that we just witnessed a move from $4,200 to $5,300 in less than 3 months. If the underlying drivers of that move continue to accelerate, there's no mathematical reason the next $12,700 gain would take longer than the last $100. Which brings us to something you need to be aware of that's being discussed in very quiet circles within the banking sector. There's increasing chatter about what's being called a potential February freeze, a scenario where access to digital funds might be temporarily restricted while financial institutions restructure their systems to handle the currency volatility we're experiencing. Now, I want to be clear that this is not confirmed policy and nobody's officially announced anything, but the pattern of preparation we're seeing suggests that contingency plans are being updated for a scenario that was previously considered unthinkable. According to sources familiar with Federal Reserve planning documents, banks have been instructed to update their protocols for extended closures beyond standard holidays. There's precedent for this. In 1933, President Franklin Roosevelt declared a 4-day banking holiday to prevent bank runs during the Depression. In 1971, President Nixon closed the gold window and ended dollar convertibility to gold without warning. When the financial system faces existential stress, authorities have historically chosen temporary closures over permanent collapse. If a February freeze were to occur, here's what it might look like based on the scenarios being modeled. You wake up one Friday morning to an announcement that banks and brokerage firms will be closed for 3 to 7 days for system updates and account reconciliation. During this period, digital access to your accounts through apps and websites would be restricted. ATM withdrawals would be limited to small amounts, maybe $100 to $300 per day. Credit cards might work for essential purchases, but large transactions would be blocked. The stated reason would be cybersecurity concerns or necessary upgrades to handle new payment systems. During this freeze, gold would likely continue trading in global markets that remain open, probably in Asia and the Middle East. The price would almost certainly surge during any period when Americans cannot access their accounts to buy or sell, because that's when the supply-demand imbalance becomes most extreme. You could easily see gold jump from $5,300 to $6,000 or higher during a week when most Americans are locked out of participating in the market. By the time the banks reopen and you can access your funds again, the price would have moved substantially higher and your purchasing power would have been diminished by both the banking freeze and the currency devaluation that triggered the freeze in the first place. I'm not telling you this to create panic. I'm sharing this so you can make informed decisions while you still have options. The pattern we're seeing suggests that the authorities are preparing for scenarios that they publicly claim are unlikely. When banks start stress testing for events they say won't happen, smart people pay attention to what they're preparing for rather than what they're saying. This brings us to the fundamental question that every American needs to answer for themselves right now. At $5,300 per ounce with 6-month delivery backlogs, with central banks buying at a pace that exceeds total mine production, with foreign institutions de-dollarizing as fast as they can execute trades, and with mathematical projections pointing toward $8,500 or higher, what is the right decision for protecting your family's wealth? Here's what the OG investors, the old guard who've survived multiple financial crises, are saying in private conversations. At $5,300, we've moved out of the accumulation phase where you buy gold as portfolio insurance at bargain prices. We are now in the wealth preservation phase where the goal is simply avoiding the loss of purchasing power that is about to accelerate across all dollar-denominated assets. The window to buy cheap insurance has closed. What's available now is expensive protection that's still cheaper than the alternative of holding paper promises that are being systematically devalued. The critical distinction to understand is between paper gold and physical gold in your possession. ETFs, mining stocks, futures contracts, and digital gold accounts all have counterparty risk. They're promises that someone will deliver gold to you at a certain price under certain conditions. When the system is functioning normally, these paper proxies work fine. When the system is under stress, like we're seeing right now, the gap between paper prices and physical availability becomes a chasm that swallows wealth. Physical possession means you've eliminated the counterparty risk entirely. You're not trusting a bank to honor its commitments, or government to respect property rights, or a digital system to remain accessible during a crisis. You've converted your paper wealth into a tangible asset that has held value for 5,000 years of human civilization, and will continue holding value regardless of what happens to the banking system, the dollar, or the political situation. This isn't about becoming a doomsday prepper or abandoning modern financial systems entirely. This is about understanding that we're living through a monetary transition that happens maybe once per century, and the people who recognize these transitions early and position themselves accordingly tend to preserve and even grow their wealth, while those who cling to the old paradigm out of comfort or denial tend to see their purchasing power evaporate. Think about your grandparents or great-grandparents who lived through the Great Depression. The ones who survived with their wealth intact weren't the ones who had the most money in bank accounts. They were the ones who owned real assets, tangible things that held value when paper wealth disappeared. We're facing a different type of crisis now, but the fundamental principle remains the same. When confidence in paper systems breaks down, tangible assets become the only reliable store of value. Gold at $5,300 is expensive compared to where it was 5 years ago. Gold at $5,300 is cheap compared to where it is going based on the mathematical necessity of currency debasement to handle our debt load. The question isn't whether gold will rise further. The question is whether you will recognize this moment for what it is before the opportunity to protect yourself at current prices disappears entirely. The signs are all there. Central banks are buying at unprecedented rates. Refineries have 6-month backlogs. Billionaire family offices have moved 40% of their portfolios into physical metal. The dollar index has crashed. The debt-to-gold ratio points to $8,500 as a mathematical target. Banking freezes are being quietly prepared for. This is as clear as financial warnings get before the event actually happens. What you do with this information is your decision to make, but understand that decisions have consequences. And in times of monetary crisis, the decision to do nothing is itself a decision to accept whatever outcome the system delivers to you. The people who preserve wealth through currency collapses are the ones who act on evidence before the crisis becomes obvious to everyone. By the time it's obvious, the protection has already been priced out of reach. We started this morning looking at gold hitting $5,300 and asking what it means. Now you know. It means the repricing has begun. It means the math has finally caught up with the policy. It means the window is closing on preparations that could have been made more cheaply last year or last decade. And it means that what happens next depends on whether you are positioned for the world as you wish it were, or the world as it actually is.